Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, June 5, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had a mixed market out here today. The S&P finished up just short of 2 points. The transports were down, the financials were down, the Dow Jones Industrials were down slightly, but more of a rounding error, down 13 or 14 points. And the Nasdaq Composite was up. So we had a mixed message in the market. It was basically a flat day all in all. So what I'm going to do tonight is I'm going to run through some of the analysis that I do. I'm going to run through various charts on various different markets. I'm going to point certain things out, and we're not going to say whether they're bullish or bearish or important or not important. I'm just going to point certain things out on various charts, and then we'll circle back around, and I'll give you my thoughts on what I think is going on. So be careful, because right now you're getting into my mind, and that's certainly a dangerous place to be. So since we already have it on the screen, the SPY. So today we achieved 275.45. We talked about that level. We've had this level on the chart for quite some time. Today's high happens to be 275.53. So we overshot that level by about 8 cents. Missed it by that much. So we also put in what's known as a doji candle today. Is that going to be significant? Does that mean we're going to get a trend change? We put in a doji candle after we hit an important price on the chart. We'll get back to that. By the way, traders, thank you for making the comments and postings underneath the videos. They're helpful to everybody. Please continue to do so. I love the interaction. Also, please continue to like the videos and also share the videos with anyone you think can benefit from this information. Okay, let's take a look around different markets, see what we can find. We're just going to look at the daily charts for now. We're going to start with the Nasdaq Composite. So the Nasdaq Composite, and you'll start to see the reason why I'm bringing all these things to the forefront. The Nasdaq Composite actually made a new high today and closed above the previous high. That's interesting. So here we have the old high of 76.37.27. Today the close is 76.37.86. It's not an accident or a coincidence that we closed even a fraction, less than 1 point away from the previous high. So we're at a new high and a closing high Nasdaq Composite. Okay, we noted it. It's a puzzle piece. It's on the table. Let's look at the Nasdaq 100 or the NDX. This is the NDX cash index. We have a doji candle. We did not close at a new high. Interesting. A little bit of a divergence. Not terrible. Not a whole lot. It's just something that I want to note down. I want it to be a puzzle piece on the table. I'm just taking in all the data. I'll decide what's relevant, important, and what could be acted on later. Right now, it's a puzzle piece. It's on the table. No new closing high today. Pardon me. There is a closing high today. We just didn't close above the old high in the NDX that was back here in March on March 13th. That high was 71.86.09. That's not what we closed at today. We closed below that level. In fact, we didn't even get to that level today in the NDX. This is the Nasdaq 100. This is the 100, for all intents and purposes, largest companies in the Nasdaq. This is your Googles, Amazons, Netflix, Nvidia, the list goes on and on. Next, we'll go over to the S&P Cash Index. This is the same as the Spider, and you can see as we compare to where we are in the Nasdaq at old highs, new highs, in the S&P, we're not even close to old highs. So it's important information, but I also want to note that we are on a breakout out of this consolidation pattern that we've been discussing for quite some time. So that is certainly of note. It's important information. I don't want to discount it. I want it as a puzzle piece on the table. It's very important information. The S&P 500 nowhere near highs where the Nasdaq is. However, we are breaking out of a recent consolidation pattern that would likely mean near-term higher prices coming. About the Dow, we never look at the Dow. Here we are in the Dow. Looks similar to the S&P 500, but not the same. We're not breaking out of a recent consolidation pattern, yet we are stuck still beneath the 100 period moving average. Now that moving average isn't all that important since we've been trading in and around this 100 period moving average for all this time. So it's not like a terribly large level of resistance anymore, just noting where we are on the chart. But it looks very similar to the S&P. We're nowhere near the old highs like we are in the Nasdaq, but it should be noted it is the weakest index of all of them. So the strongest happens to be the Nasdaq, the middle ground happens to be the S&P, and the weaker index happens to be the Dow. To compare and contrast just a minute, here's a chart of the Russell E-mini futures contract. So this is the Russell 2000 futures contract, and you can see we're in absolute breakout mode in the Russell 2000. It looks very similar to the IWM. In fact, it really looks the same. We're in breakout mode in the small cap index. The Nasdaq Composite is really second in line, challenging the old highs. The S&P is breaking out of a bullish consolidation pattern, and the Dow is lagging behind, not yet breaking out of its recent consolidation pattern. So that's the progression of the indexes. Now the question is, how do we look at all this stuff? What does it mean? And what can we derive as a result of where price is on all these different charts? Bigger picture first. Higher prices are coming. Where do I draw the line in the sand to say no longer do I believe in higher prices imminent? I believe in more downside coming. That on the S&P, or we'll use the SPY chart, happens to be 273.25. Right now, that's my line in the sand. We begin closing daily below that level, and we'll begin talking about other numbers of support on the downside. And in no way, shape, or form am I calling for any kind of collapse. I'm just saying right now, I believe that markets are breaking to the upside. We'll talk about this more in a moment. But where do I have to take that off the table, at least temporarily? And that's daily chart closes below 273.25 in the spider chart or on the spider chart. Now, does it have to start tomorrow? No, of course not. We can certainly have a pullback. Any pullback I would like to see contained by 273.25. Now, if we did get a pullback for a day or two, for example, and the market was not able to close below 273.25, and that acted as a fair, decent level of support, then that would be another catalyst for higher prices to come. Do we have to come back and test that level of 273.25 in and around that level? We don't have to. There's now an open gap that I believe will get filled. This is really, in my mind, the way I look at things, a breakout area. So I would say between the gap and the fact that this is now a breakout area, markets like to come back and test former breakout and breakdown areas. I would expect that we'll come back to test 273.25. Can we go higher first? Yes, I believe we can, but I also believe that we'll come back to test this level, and I would say that chances are greater sooner than later. However, if we don't, and for example, tomorrow, meaning Wednesday and Thursday, the market continues to grind higher, then that becomes less and less likely in the short term, and the market will likely go into melt-up mode into the next resistance area that will come in at 278, and then we have a natural area of resistance right around 280. But in the short run, I think we could come back and take a swipe at this gap and a swipe at 273.25. I think that level's important. I think it's not uncommon for the market to want to come back and test that area pretty quickly. Either way, it doesn't change the bigger picture that I think either that level is going to provide support or we're just going to take off to the upside and higher prices are coming either way. Looking at the Nasdaq Composite one more time, the closing high or the closing price above the former high intraday high in the Nasdaq, to me, is an important development. Doesn't mean we're just going to take off from here. We can. However, you can see some market symmetry that's already developed. So if you take a look at this low down here, we have a consolidation, and then we have another high. So we're getting into the point where you can make a case that there's some market symmetry. This leg is around equidistant to this leg. However, I think at a minimum that it's a shot across the bow. It's the market's way of kind of sending up a smoke signal to say, hey, higher prices are coming. I'm closing at a new all-time high. Higher prices are coming. And then somebody will read into that, hop on, and the market will likely pull back. But I still think it's a smoke signal, similar to how we use the highs of breakdown candles and the lows of break up candles, a close below, a close above. It's the same concept. I think a close above the all-time high in the Nasdaq Composite is a shot across the bow. That's the way I'm reading it for now. You know, in the Dow, we have a different story. So let's go to the weekly chart and see what we find. Well, we find a familiar pattern, one that we found in the financials before, and we find a pattern that until and unless the Dow can close above the high of this breakdown candle, 24,977 spot 65, until we can close above that breakdown candle high, then this is still in jeopardy of this bearish pattern playing out to the downside. But look what we have on a shorter duration within this pattern. It's a pattern within the pattern. It's a conflicting pattern. We have an up move and we have sideways consolidation right around the 20-week moving average. Is this building energy to get through and have higher prices in front of us? That's a very distinct possibility. So when I go down to the daily chart in the Dow, I can see here that maybe the Dow is simply building energy on the daily chart in order to just eat time off the clock until it's ready to bust through the 100 period moving average and challenge some of the next natural areas of resistance in the Dow, namely here and also here. So maybe when we look at the Nasdaq Composite and we look at the IWM or the small cap index, the Russell 2000, maybe they're just going to essentially pull the lagging indexes up along with a market that's at least in part in breakout mode. When we look at the IWM, it's very hard to argue against this market. As soon as we got above 160.63 and we stayed above there, that was it. We back tested it twice and we were off to the races. As long as we stayed closing above that level, higher prices were coming. Higher prices are still coming. There's nothing wrong with this market at all. This is a bullish market and it is a leading indicator. That's why it's my favorite market leading indicator. Now you see why I'm taking my cues mainly from the IWM. The IWM is leading the market on the upside. You can see where the Nasdaq is. The other markets have some work to do on the upside, but the S&P is now coming out of a bullish consolidation pattern. The Dow is lagging behind, but it can certainly get pulled up with these other markets. The IWM is on a breakout. It will likely pull the other markets along with it. The transports, my other second favorite market leading indicator, the transports was down today. It was down 44 points, less than 0.5%. It's nearly not a big deal in the big scheme of things. It was certainly down much more earlier in the day. It looked like it could wind up to be a pretty ugly day for the transports and the financials for that matter. We'll get to that in a moment. But at the end of the day, all we really did was trade down a few points, still around the highs of the upper end of this channel, and we're still threatening to break out above this channel. So we've now been consolidating in the upper range of this channel. If the transports were up large today, along with the IWM that was up, then I would have even more conviction in the upside momentum that I think we're about to see. But we'll see if the transports can break out of this particular range that it's been in for the last couple of weeks. And that should happen if the market decides to continue on its breakout mode. A rising tide will likely lift all boats. Just a glance over at the Qs. You can see here we're challenging the old highs. The old high happens to come in at 175.21. We didn't quite get there today. The high today was 175.13. Put in what I like to call a pseudo doji candle. There's really nothing wrong with this market. It's very, very bullish. Looks like it wants to break out. Will it be a pullback first? Are we going to go sideways or maybe have a fake out and pull back first? Entirely possible. Again, markets love to trick, trap, fool, and frustrate as many investors as traders as possible. However, we're challenging the old highs. This market is very bullish. The moving averages are trending in the upward direction. We are a little extended from home base, so I wouldn't be surprised to see the market go sideways a little bit, even pull back a little bit, try and let home base catch up to price, or let price come down a little bit to home base. However, this is still a very bullish chart. We're going to go over to the XLF in a second, but let me just wrap up the major markets for a second and say that I'm using as my line in the sand across all the markets for that matter, the 273.25. As long as we remain on a daily closing basis above that level, then I believe in the upside, more upside in this market. If we trade below, close below that level, I'll have to reassess. We'll begin discussing it at the time. But right now, as long as we're above this former consolidation point, I have to believe this market is poised to continue on the upside with this further breakout. Now, after that being said, the financials, in comparison to everything else we just looked at, look terrible. That's what I see on the daily chart. I see a chart that is a potential warning sign, a canary in the coal mine. Now, if the financials begin to break down, we're going to end below the 200-period moving average and begin to close back below that level on the daily chart and begin to trade down to this former pivot area, down to, 2670, 2650. That's going to be a big warning sign, and we're likely going to have to take a closer look at whatever's going on across the other markets. We have to watch the financials very closely. Now, I don't like to correlate markets, you know that, but certainly without the financials, it's unlikely we're going to see another major bull leg in this market without participation from the financials. Now, can the financials participate? Can they actually turn around, get above these moving averages, and start to grind higher? They don't have to make new highs. That's not what I'm saying. But they do have to participate in the direction that the other markets are headed if we're going higher around the same time as the other markets. So what I'm saying is either the financials are going to melt down and we're going to have a bunch of false breakouts in the other markets and they're going to come down too, or the financials are going to have to catch up on the upside. But it's unlikely that we're going to see a major bull run in the upside in all the other markets we just looked at and the financials are going to be heading lower simultaneously. An unlikely scenario. When you look at the weekly chart of the financials, again, it just does not look very good. Now, we can rally in the financials even to the high of this breakdown candle, right up into around that $28.75 to $29 area. That would be a big run from where we are and still stay in this bearish wedge formation and still have another leg to the downside. But if we get back above that 20-period moving average, that's going to be bullish. It's interesting, to say the least. You have diverging markets, and trying to put all that data together in the same bucket, mush it all together and see what we come out with on the other end. Everything except the financials points to higher prices. Are we going to have a lone canary in the coal mine and we have a bunch of false breakouts? We'll see, but we'll know we have important breakpoint prices along the way that are important to me that we'll be able to identify a change in complexion to this market. While we're at it, we might as well look at the SOX. And what you see in the SOX is, and this is the SMH, this is the exchange traded fund that tracks the SOX. You see, we're not at new highs, but we're certainly making a run for the old highs. We're above all the moving averages on the daily chart. It's in a bull run. There's nothing telling me right now that this is going to stop on a dime and collapse. So this is bullish. And if we go over to the weekly chart, what we see on the weekly chart is we're challenging the high of a breakdown candle. It's not that far away. This will be a very important weekly close. Close above this high that we broke down from on the 23rd of March. And guess what? Then we'll take a run for the old all-time highs in the SMH. So right now, the SMH has had some tremendous run off of a touch of the 50-week moving average. Remember what I told you last night about the institutions? They look at the 50-week moving average as ultra important. When markets or stocks or whatever they're trading begins trading and closing week after week below their 50-week moving average, that's when they begin to redistribute their portfolios, rebalance their portfolios. They like to be in a longer-term weekly uptrend. They rarely buy on sale. They like to follow the trend. So knowing what they're likely going to do, likely going to come in support around a 50-week moving average. And if that's not the case, you know there's likely more downside coming in whatever market we're discussing or looking at the time. The gold market, last night I said that any close below 1297 spot 50 would be bad, would be negative for gold. We closed below that and we're up $3 today. So all in all, it's not a buy, it's not a sell. We're basically consolidating in a longer term bearish pattern that should result in lower prices, but you can't take higher prices off the table. But we are right now contained by the fact that we're below the 20-period moving average, can't seem to trade above that. We have a shorter-term bullish pattern inside of a longer-term bearish pattern. They're conflicting patterns. This is not a market that I want to participate in right now on the long or the short side. Just leave it alone. All right, crude oil. We talked about 64.50 being extremely important to crude oil. It's extremely important to crude oil. That level held. We didn't touch it yesterday. We made a low yesterday at 64.57, and then today we made slightly lower low, and we made a low of 64.22, and now we're trading upward away from that level. Currently, as I make this video, 65.5, so we're $1 north of that support level at 64.50. It's not to say we can't come down farther, and I would be a willing participant at 63.27, 63.25, 63.40. In that neighborhood, depending on how the market gets there and what the shorter term charts look like, I would be a willing participant down in the low 63s to mid 63s, but I think this area has a very solid chance to hold, and if I'm right, this could be the pullback that catapults us into the hot zone that we've been discussing for quite some time. And that is correct. I am not suggesting just yet that the upside is off the table for crude oil. Yes, we did have a pullback. Here's a weekly chart. We had a pretty nasty 2.5 week pullback with crude oil, but we've had that before, and I don't necessarily think that the upside has to be off the table. This is still in an uptrend. It's just a pullback in an uptrend in crude oil thus far. If this uptrend is broken, and you can see a rough diagram here or a rough idea of a trend line that I'm looking at, and this is not any way, shape, or form exact, but I'm looking here and I'm saying until and unless we close below this area, and I've got that 64.50 as a pretty important number, so it kind of coincides. This was imperfect how I drew this in, but kind of coincides with the trend line. That general area, if that's broken, I'll begin to think that I could potentially be wrong on the remaining portion of the upside, but I'm not taking the hot zone off the table just yet. So this is an area that I'm willing to be long crude oil until we start closing daily below 64.50, and it looks like I'm wrong. And if we close below $62, then I'm absolutely wrong, and much lower prices are coming. But right now, right here, I think this is a reasonable long side trade on this pullback in crude oil. One of the reasons, not nearly the only reason, but one of the reasons is today is an important day on this chart, and traders who have taken the course at lazyeMinitrader.com understand exactly what I mean by today is an important day We could have been expecting a turn today, and look at that, an important day in terms of time against an important price in terms of support. So an important turn could potentially be coming in around an important price. That's an area where I would be comfortable getting long a particular chart pattern like this. And I think that'll about do it for today. I'll leave you with that. You can chew on that for a while. It's everything I wanted to and intended to discuss. Therefore, I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.